Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to hit up Twitter, see what people are sharing on social media like I normally do. I'll give you my financial opinions. It's probably going to be related to three different topics: wealth building, financial topics, and or commodities, because that's where I think the value is over this next decade. Let's dive in. Let's see what's going on and what people are sharing in the markets. At finding_finance is where you can find me on Twitter. And if you want to join our community, finding-value.com, that's where we talk about individual companies in a bunch of different commodity sectors: uranium, oil, nat gas, energy service, coal, shipping, dry bulk shipping, tankers. There's a whole bunch of stuff that we do cover: copper, diversified miners, aluminum, goes on and on. So I said just an opinion, but Occidental CEO sees oil supply crunch from 2025. The ratio of discovered resources versus demand has dropped in recent decades and is now at around 25%, which is very concerning, at least to me. Oxy CEO Hullup says 2025 and beyond is when the world is going to be short of oil. Oil industry executives have been warning that new resources, new investments, and new supply will be needed just to maintain the current supply levels as older fields mature. Maybe he's referring to peak oil. I know some people get pretty put off by peak oil and that name, but to me, that's kind of what he's alluding to. And he's saying, you know what, we need to make a lot of new investments just to basically stay flat. And I think that will be very good for oil companies that can still grow production. Not maybe the big ones, but there's smaller companies up in Canada that can grow production. There's other ones around the world that I think still have some room to grow production in their own little area. But worldwide, yeah, we're gonna get struggling here, and I have a feeling that a wave of investments is going to come towards the energy service groups over this last second half of the 2020s. Joseph Wayne, he says, this is why I think the stocks will crash upward, not downward. In my opinion, if we get into a recession, then the government will just spend even more. So what we're looking at here is Bob's got what he says is pretty incredible to see COVID period like deficits being run at a time when unemployment is at secular lows and the economy is growing above potential. In the short term, this helps delay any incoming recession. Long term, it will make managing an eventual recession difficult. And you can see the spending here. So if we look at this, we've got 2020, which is the red line. You can see the deficit that it created here, the red line there. Then the orange line in 2021, we are deficit spending. And in 2024, this first month here, you can see that we're basically on the same path as 2021. And I know some people think that we're going to get a slowdown in the market. And what Joseph is saying is he's saying if you run deficits like this that are so large, he says he thinks that stocks will crash upward because of that inflationary push from the federal deficit. And that's what I was talking about: fiscal deficits. It's the deficits that might mask a recession nominally. So he says, in my opinion, if we get into a recession, then the government will just spend even more. It's going to be a real GDP recession, but it's going to be hidden through nominal deficit spending. Canadian Venture Exchange CDNX versus the S&P 500, up 1%. Where will money flow? Closing in on a massive trend break. RSI, MACD bullishly broke out weeks ago. Fuse is lit. So what he's saying is basically what I think is occurring is that we are going into a gigantic bull market in commodities. And that's going to help the Canadian, the CDNX versus the S&P. We are basically bottoming in this ratio and ready to break to the upside. And what he's showing here is the RSI, which is relative strength indicators, moving up, and the RSI and MACD are both basically breaking to the upside here at any second. And then we've got our downtrend line. The way that I view this is I just look at the up candlesticks and the down candlesticks, which is the same thing as the relative strength indicator. It's the same thing. I just look at it a little bit differently than they do. U.S. nat gas demand hit a new record high. Look at that bad boy right there from our cold little streak across the entire United States, ripping through gas demand. We've got oil gets extremely volatile around recessions. In a recession, oil plummets, and after recession, oil spikes. What maybe this person knows or doesn't know is it's the stimulus money that comes into the system that recharges this. So it's not that it's after a recession that it goes way up. It's the credit that's been created and the stimulus that comes into the system that boosts oil. Oil is the most credit sensitive asset. So this was a bust from the real estate market in 91, and you can see how it ramped up right before that bust. It ramped up right before the bust in 2008. And right now, we haven't ramped up before a bust or anything like that. So, when I look at this, I mean, maybe we're located somewhere like, I don't know, 2001 or two or three or something like that. And I think we're going to get a big move to the upside eventually at the end of this secular bull market that we've got in oil. But we're not there yet. This is just the first leg up, which I think is equivalent to this leg in 98, 99 here. The ratio on commodity to stock ratio is still, it's down in the dirt. So we've got a long valuation runway ahead of us, in my opinion. Good Redfin feature on demographics and housing demand. Boomers are not going to sell until they pass away. Millennials are all trying to get into the market. Demand will peak in the next 5 years forever demographically, but that's a long ways away. So we're short right now. He's saying that we would peak about 5, 6, probably 5, 6, 7, 8, 9, 10. Depends when the first time home buyers, that demographic kind of dwindles down. But right now, we've got a peak here in about 30 years old. And the first time home buyer, when I last checked, was 36 years old. So that chunk of demographic coming through at 35, 36 years old is probably where it will peak. I think we still have at least 5, 6 years more to go, but then we still have to build the home. So we'll see how that interaction between those two work. This is global gold, number 2 Barrett Gold in Q4 production update this morning. All-in sustaining costs per ounce are expected to be 8 to 10% higher than the prior quarter, according to Barrett Gold's numbers. So he says, you got to be kidding me, says the market. Gold shares down 9%. So I know some people have asked me about larger gold companies. The problem with a lot of these gold companies is I think they're going to start losing their grades. Their grades are going to go down, and it's going to get even more expensive to extract it out of the ground. So I think their reserves will dwindle down. They're going to start to go after lower and lower ore grades, which costs even more money. And then you're going to start to see inflation also impact their all-in sustaining costs. It's a combination of all those things. So yeah, I think some of these bigger mining companies are gonna struggle in terms of making money. Tavi says the spread between the 2 versus 30-year yield just turned positive. Last time this happened from deeply inverted levels was in late 2000, right after the S&P 500 also marked a double top that resulted in the tech bust. So we could see another tech bust. I don't think we'll see a great financial crisis for the fact that the housing market is we're in the middle, in the thick of the demographic coming through. It's not going to be a great financial crisis where the house prices crash. I think we could get a tech bust though, and we could see a decline in stock in certain sectors of the stock market. It could be a good pullback, and that's where my eyes are at, watching these different duration yield curve, the uninversion of it. So yeah, we could get a slowdown in the market, and it could impact, I would say, the majority of stocks across the board. It will impact, I think, the tech sector probably most heavily. But again, we'll see what it looks like, and when it occurs, we'll see that slowdown in the market. Morgan Stanley sees uranium as its top commodity pick for 2024, a perfect storm of rising utility contracting. Spot market and exchange traded fund purchases are supporting demand, with a low likelihood of price related demand destruction. So that's what they see coming for uranium. It's one of their top picks in 2024, and I would agree with that. JC says, you notice how whenever stocks are under pressure, the treasury bonds can't catch a bid. It means that yields are going up. That's because treasuries are not acting as a safe haven in this cycle. Bonds are moving with risk assets. It's taking many investors way too long to come to terms with this. We like that. So, keep in mind that we could have problems in the bond market where rates will go up and it's not the safe haven that people think it is anymore. Things might be changing as we go through the supply demand of a lot of these treasuries. There's a lot of supply. Martin says, I'm sorry, but this is the strangest I've ever seen things with oil, considering the escalation in Middle East geopolitics. That said, fantastic for global consumers that oil prices are not moving at all. And maybe oil is trying to be manipulated to some extent, because I know Russia funds a lot of their wars with the price of oil moving up. So I don't know. Maybe it's recessionary fears that are causing it. I'm sure I could come up with 3 or 4 or 5 different things that could be moving the price. And I don't think it's necessarily manipulation outright, but I think it's probably more recessionary fears in the short term, would be my guess. But yeah, it is kind of weird with all the geopolitics out there, and there's really no premium in this price here. At least I don't think so. So I want to go. I'm going to skip down to this one. Lance Roberts says, on an inflation-adjusted basis, household checking and savings are declining rapidly. And I look at this, and this is what the checkable deposits and currency asset level is. We were at like nothing in 2007. Look where we are today. So although this is declining, it's coming from a ridiculous level of 4.5 trillion, at least for checkable deposits and currency asset levels. You'd think that uranium breaching the $100 mark would wake up investors en masse, right? Well, they appear to remain sound asleep. Case in point, Reddit. Wall Street bets, 3 posts, stocks, 000. See you at the greed stage. So a lot of people think is that we're in the media attention phase, which I think is probably true. The price has moved up quite vertical in the uranium futures pricing. The equities haven't really done much. And I don't know if that's just people waiting for a potential slowdown in the market, a potential recession. Are we going through one? Or is it just we haven't really gotten the attention yet? And all of these things will go vertical if we get to the greed phase. And I don't think we're in the greed phase, guys. I think we're in media attention. And I can say that based off of the producers moving, the developers are starting to move, and the explorers really haven't moved yet. So if the explorers haven't moved yet, I think that this is probably where we're at, coming out of the bear trap into the media attention phase. Totally agree. And generally speaking, when we get over to this enthusiasm phase, that's when all the explorers start to move big time. So yeah, I think this person has accurately identified exactly where we're at. And he's probably saying, no one's really talking about it, but we'll see you at the greed phase when everybody gets greedy and they start to see all the big moves, people FOMO in. So this is new. National Bank of Canada states that Canada has entered the first population trap in modern history, something that normally only happens to third world countries. It's where populations surges so fast it actually impedes economic growth. So the housing supply deficit hits a new record. God, guys, this is people per housing unit started. So this is basically a per capita housing starts. And you can see that we just have a massive deficit up there. So I know people have asked me, what do you think of the Canadian housing market? I didn't realize that the deficit is this big. I mean, that is pretty ridiculous. So I think it's going to remain under pressure if you've got this many people and so few homes. That the pricing pressure will still exist for a while. Sandridge Energy Incorporated announces a one-time $1.50 per share dividend and a 10% increase on its ongoing quarterly dividend to 11 cents per share from the current 10-cent per share dividend. This is what occurs when you have cash flow. Cash flow breeds dividends, share buybacks, and all of that. Now, the very speculative companies can move up as long as there's interest and money flowing into the sector. Money flows is what determines asset pricing. But these guys can kind of take some of this, the bull by the horns, so to speak, and kind of control somewhat their destiny by buying back shares and returning capital to shareholders. Northstar says, why he's been in uranium for the last 4 years and not in the NASDAQ? Because I forecast uranium would beat NASDAQ, and it has ever since this. So he's using the ratio to determine what asset to be in. But yeah, URA or the uranium sector and a lot of these companies in it have done really well, incredibly well. When the commodity bull starts going, I don't think the NASDAQ is going to beat much of anything because when commodity companies start moving and the commodity price goes above a lot of the high cost producers' cost curves, they really start to return massively in terms of their returns. So I'm going to be in a lot of oil companies and nat gas companies and uranium, all these commodity energy companies, because I think there's going to be a deficit in energy at some point, or a squeeze, I should say. And then the energy service companies, they're gonna get a lot of money that passes through the exploration production companies into the energy service companies. So I think all those sectors are going to do very well over the long term, and they're all going to beat the Nasdaq. This is uranium. Using fact-based technical analysis removes any need for any kind of emotion and narrative. This is uranium versus uranium miners. We've got kind of two tops here, a breakout, a retest. Uranium miners surge when it goes down. Uranium miners struggle when they go up. So, yeah, I think the uranium miners are going to surge here at some point. We're going to see this ratio drop, is my guess. I'm in the red camp. Scrolling down, we've got this big gap between the CRB index and gold. So, gold and commodities index, CRB, diverged at the 2008 Great Financial Crisis. Then the CRB dropped into 2020 lows, which I called. It was clear back then that a new commodities bull has started. And with the enormous divergence back then, it was clear the moves were going to be massive, have been and will be a massive move to get back to a more balanced gold to commodity ratio. And remember, gold is incredibly cheap in relationship to stocks and other asset classes and the M2 money supply. So we can go up in commodities dramatically to get back to a historical parity of something like the 1970s or 1980. If we were to get back to a parity of 1980, remember, gold's going to go up at the same time that the CRB is going to go up, much like from 70 to 80. They both went up together. So we could see I think gold could go to maybe $8,000 an ounce, and we could see the CRB index go up at a faster pace to catch gold. And I think that's very much a high probability, possibility and probability. It's a high probability that will occur, and that there will be an outperformance in some of the CRB index. So I think oil is going to be a huge winner in the late 2020s. U.S. banks are facing unrealized losses of roughly $685 billion. They are desperately hoping the Federal Reserve will cut rates sooner rather than later. to help them with their unrealized losses here. So they've got held to maturity securities and available for sale securities. They've got big losses there when rates went up. A lot of it is probably bond related. General reminder for the gold camp, best is yet to come. And what he's comparing here is the Fed funds rate and then gold. Whenever you go and you pause, that's when gold really starts to take off. It's the pause and then the lowering of the interest rate. The pause, you can see gold starting to take off, and then the lowering of the interest rate. That's also very similar to the uninversion of the yield curve. This is what people are missing. They're missing when gold does well, the market condition that gold does well under. This is the market condition that it does well under. It's when they do a pause and then they lower rates. They're supposedly supposed to lower rates coming up at some point. That's generally when gold rips it. Hopefully that relationship will continue, and hopefully they lower rates here sometime in 2024. This is a chart from Raymond James showing where we are at in the oil field services cycle. We are emerging from the bottom. So we have a greater amount of investment. Actually, he's got the drillers down here: PD, ESI, NBR, HP, and P10. Those are all the biggest drillers in North America. And what we're seeing is we're seeing a large sell-off 2016, 17, 18, 19, 20, and we're starting to come back up into favorability in terms of the, I think that's, I don't know what ROIC, something capital, or here it is, North American Driller Net CapEx. I think that this is going to inflect to a positive number probably in 2024, 2025. It'll probably be inflecting in 2024, and then it will go positive in 2025. That's my guess from the stuff that I look at. So that's what we've got there. Got a big breakout back in 2023 as expected. This is uranium. Then it used a bullish rising blue wedge to handle orange resistance. Caught all major lows. Yep. So look at that thing rip, guys. This is the SPUT, uranium physical ETF or ETN or however you want to call it. But this thing is ripping to the upside. It's definitely a breakout from a 15-year base. The bigger the base, the higher in space. Well, that's what we say. Another one that's got a really big base, which is even bigger than uranium, is silver. Silver's another one to watch. Oh, and here, look what we got next. As said lately, you are watching this historical inflection point. Gold has now broken out above the blue lines. Silver's just sitting below its massive 12-year blue breakout line. This is a squeeze up 12-year. It's ready to break to the upside for silver. I think that we're just waiting for yields to drop and for the yield curve to uninvert. The yield curve's already uninverting, but yields haven't dropped yet. And then gold's also above a breakout, and it looks like we're ready to run in gold too. And these are obviously correlated, so they both look very good, and they're both squeezing up for a break at some point. Watch for yields. This is the U.S. break-even inflation rates ticking up for tips, and you can see on the right-hand side that they're going up. So yields are going up, and maybe that's going to continue. Upward yields are going to put pressure on gold and silver in the short term. But in the 1970s, they went to a certain level, yields did, and then gold and silver broke out anyway. So again, we'll see if that relationship sticks with time. Coming down, lots of stuff going on there. This is ARC. Set to open right in the thick of this week. Left shoulder, head, right shoulder. Is this a head and shoulder that's ready to peak and go lower, or is this a lead-in pattern where we could rip to the upside? I'll wait and see. This is the B of A secular bull market roadmap. This is the commodity bull markets in between. I don't know if we've entered the commodity bull market yet necessarily. I think that 2020 was the bottom. And I think that if this were to come back down, it would be obvious that we're in one of these periods here of commodity bull markets. So are we going to enter a secular bear here? They're saying that we're still in a secular bull, 2013 to present, and that very well might be the case. And maybe this pullback that we got was the stimulus money and the interest rates going up. And that eventually will lead into a bull market in commodities here at any point. 2024, 2025, whenever we, I think, exit the slowdown in the market, they lower interest rates. I think the housing market's going to go back up. And I think we'll get a big commodity bull market out of it. But here's TLT. TLT downtrend line of that. This is for 2022, a breakout, and then we're going on up. Is that the case? We'll see for TLT. This is prices. We could pull back even further a little bit too. And then energy for 2024, S&P oil and gas refining and marketing continuing to go up, all-time high. And that is where we're going to end it. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. We have a question and answer session coming up on Saturday, 7 a.m. Mountain Standard Time for those members that want to ask me questions directly about whatever. And that's all I've got for today. So we'll catch you guys later. This is Finding Value.